You may have heard somebody say something as ridiculous as, oh, I don't want a raise because it would push me into a higher tax bracket and I'll end up taking less. Well, it's a lot common that you think. It's also possible that you may have thought about this yourself, and honestly, it happens a lot of times. You see, taxes, the way we see taxes is we see it as some invisible line that if you cross it, you end up into financial disaster. But the truth is, it's just a myth. That's not how taxes actually work. And I really want you to know something, that in Canada, we work a progressive tax system, and earning more money will always ensure that you finish with even more money. So there's actually no exemptions. Today, I'm going to show you exactly why, using simple math, no technical words, no jargons, to show you that earning more money will actually put more money in your pocket, regardless of how much taxes you pay. So let's go. I'm going to explain this thing to you like a friend. So I need you to just flow with me, right? Canada uses a progressive tax system, which means as your income goes up, the higher portions of it gets taxed at higher rates. But, and this is a really important part, those higher tax rates only apply to the extra income, not to all of your income. So think of it like slicing a huge loaf of bread. The first few slices get taxed at a lower tax rate. The middle slice get taxed at a slightly higher rate, while the last few slices, if you have them, they get taxed the most. But here's the key thing. Here's what I want you to take away. Putting more slices on your plate, putting more slices on your loaf of bread, it doesn't change how those first slices were taxed. Those first slices are still going to be taxed at the same rate that they were taxed before. They're still going to be taxed at the same lower rate that they were taxed before. The only thing that changes is the additional slices, the additional income you make gets taxed at a much higher rate than the initial income that you've made. So see it as each income falls into a different tax bracket, and each tax bracket has a different rate that applies to it. Okay, let's use a made-up example, just a figurative example for you to understand this even better. And I really need to stress that these are illustrative figures. These are not real tax rates that I'm going to be quoting very soon. If you want the real tax rate, I'll drop a link in my description to the CRO website where you can get the real tax rates. So, but this, like I said, this is just for illustrative purposes only. So I'm going to use 3 tax brackets. So imagine we have 3 tax brackets. The first bracket is for your first 50K, which is going to be taxed at 15%. The second bracket is for income from $50,001, just above 50K, to 100,000, which will be taxed at 22%. While the third bracket is for income above 100,000, which will be taxed at 26%. Now, remember, I said these are just illustrative tax brackets. These are not actual Canadian tax brackets, so keep that in mind. Now, let's say you earn $60,000 a year. Your first $50,000 will be taxed at 15%, which is $7,500 in taxes. The remaining $10,000, very key, the remaining $10,000 will be taxed at 22%, which is $2,200 in taxes, which brings your total tax bill to $9,700. And that's how the tax bracket works. So you take out one portion, whatever is left, you fit it into the next tax bracket above. You tax it at that portion. Whatever is left, you take it to the next portion, and then you tax it at that tax rate. So based on this example, you notice that your entire 60,000 was not taxed at 22%. Instead, only the 10% above the $50,000 tax bracket was taxed at 22%. Now, imagine your boss offered you a $5,000 raise to take your annual income to $65,000 a year. What actually happens is that $65,000 is going to be split into different income buckets with different tax rates. The first $50,000 is still going to be taxed at 15%, and you still pay $7,500 in taxes on it. Now, your next income is now $15,000. That amount will be taxed at 22%, which brings your tax bill at 20% to $3,300. Your total tax bill is your taxes from the $50,000 tax income and your taxes at the next $15,000 tax income, which brings your total tax bill to $10,800. Now, you see the difference. Your tax bill increased by $1,100 from $9,700 when you were earning $60,000 to 10,800 when you earn 65,000, but your income increased by 5,000. So you see the difference? Income went up by 5,000, tax increased by 1,100. So you made a net gain of 3,900 on your income. So that's the beauty of the progressive tax system. You always come out ahead. And there's literally no point in the Canadian tax system where earning one extra dollar means you take home less pay. That simply doesn't happen in a progressive tax system. Now, I want to explain two simple terms that will make everything click. Just two simple terms that will just wrap everything in a perfect bubble, and you understand every tax thing I've been talking about from the start of this video. And they're actually very simple. So follow me. The first is a marginal tax rate. What this means is it's the rate that applies to your next dollar of income. In our example, when you were earning $50,000, your marginal tax rate was 22%. And it's just a rate at the top of wherever you currently sit on the tax bracket staircase. Really simple, really easy to understand. Now, the second concept is the effective tax rate. And this is the average rate of what you pay across your income. Now, in our $60,000 example, recall that $60,000 example, you paid $9,700 in taxes on $60,000 of income. That works out to roughly around 16% effective tax rate. Now, you might be wondering, why is this important? Why do I need to know the difference between an effective tax rate and a marginal tax rate? And I'll tell you, if someone says, I'm in the 22% bracket, what they're actually quoting is their marginal tax rate. They're not actually paying 22% on everything. Their effective rate is actually much lower than 22%. Their effective rate is usually always lower than the marginal tax rate. And these are two separate numbers, marginal and effective. And they are both shown when you file your taxes, either through the CRA My Account, or you probably use any of these online tax software. So there's World Simple Tax Service, there's TurboTax, and there are other online tax softwares that you can use to file your taxes. So the next time someone is panicking around you about their taxes, just calm them down and ask them, what is your effective tax rate? And if they still don't understand, go ahead and explain to them everything I've just taught you about marginal taxes and effective tax rates. If you've been watching my video so far, if you really like my content and you really want to encourage me, please hit the subscribe button if you haven't done so. I'm trying to get to 500 subscribers by the end of December 2026. So please, it means the world to me. So subscribe, share, like this content, and tell somebody about my channel. So let's get back into the video. I just want to point out something really quick for my Canadian viewers. And if you've been wondering, we actually have two income taxes in Canada. One is the federal tax and the second is the provincial tax. Now, each province and territory has its own income tax bracket, which is added to what you pay at the federal level. The good news is both provincial and federal taxes work on a progressive income tax basis. So it's the same understanding that applies to the federal taxes that applies to the same provincial taxes. The only difference is the rates vary at the provincial level and at the federal level. And the rates also vary from one province and territory to the other. So the total taxes you pay depends on the territory or the province you live in. But the good thing is the same knowledge applies. The same knowledge of understanding what federal taxes means also applies to understanding how your provincial and territorial taxes are calculated. There's something you might have noticed when you get a raise. Sometimes you notice that your paycheck, it doesn't actually reflect the exact amount that your salary got increased by. And it's not about your tax bracket. Something else actually happened, and I'll explain it to you. Now, beyond your taxes, there are other deductions, mandatory statutory deductions that happen on your paycheck before it gets paid out to you. The first is CPP contributions, which is your Canadian pension plan, which is like a forced savings plan for everybody in Canada. Now, the second thing is employment insurance premium, which is a contribution you make to the employment insurance fund. Should in case you're out of a job, you can draw down from your employment insurance contributions. Both of these contributions, both the CPP and the EI, they are calculated as a percentage of your income up until an annual limit. Now, when your salary gets increased, when your annual paycheck gets increased, the percentage contribution that gets deducted to CPP and EI, it also increases. However, there's an annual cap. So what happens is when you reach that annual limit, your CPP and your EI deductions stop for the year and you get a bump in your monthly paycheck, on your bi-weekly paycheck. Now, what I want you to really take away from this section is a bigger paycheck after a raise might be slightly smaller than what you expect, but it is actually bigger than what it was before. All right, let me put everything in bracket. Let's land this plane. Tax brackets, they're just ranges, they're just simple ranges. In Canada, only the income within each range is taxed at that range's tax rate. Your marginal rate is the rate on your top dollars, not the rate at which all your income is taxed. Your effective rate, which is lower than your marginal tax rate, is your real average tax rate, and and like I said, it's almost always lower than your marginal rate. And more importantly, what I really need you to take away from this video is taking a raise, a bonus, or extra hours will never ever leave you with less money. That myth needs to stop. That myth has been costing you money. So do not turn down a raise. Do not turn down a bonus. Yes, your raises and your bonuses will be taxed, but you will still end up with more money than you started off with before those bonuses or those raises came into play. Now, if you really want to understand what you need to submit for this tax season, I have a perfect video that explains everything you need to arrange before you file your taxes. So make sure you click on that one and watch it and let me know what you think in the comment section. So thank you so much guys for watching, and I'll see you on the next one.